With interest rates and home prices on the rise, it's more important now than ever to make sure that you're getting the best deal on your mortgage. So in this video, I'm going to walk you through what a lender looks at in determining your interest rate, and then I'm going to give you a couple tips on how to get the best interest rate that you can. So let's jump into it. Hey, what's up guys? I'm Ben Sund. If you've been here before, welcome back. If you've never been here before, welcome for the first time. I don't just talk about sky-high mortgage interest rates and home prices. I also cover things like personal finance, investing, and real estate. So if that interests you, please hit that big red subscribe button. So let's briefly jump into what a lender looks at to determine your interest rate. Understanding this is super important because there might be things in your personal situation that you could change in a relatively short amount of time that may drastically lower your interest rate. Keep in mind that a 1% change is $83 a month for every $100,000 that you borrow. So the first thing that a lender is going to look at, and it's the most obvious, is your credit score. Now, what a lot of people don't realize is that lenders base your interest rate off your credit score on a tiered system. So for instance, if you have a 620 credit score, it's going to be the same interest rate as if you have a 640 credit score. But if you have a 641 credit score, your interest rate's going to be lower than if you have a 640 credit score. There's literally 1 point differences depending on where you're at in the tiers. I'll go over this in a little bit more detail here in just a couple minutes, but just realize that a lender is going to look at your credit score and they're going to fit it into a tier, and that's going to partially determine your interest rate. And each lender is going to have slightly different tiers. So the second thing is the type of loan that you're applying for. A conventional loan is going to have different interest rates for your tiered credit score than an FHA loan will. So you'll want to make sure that your lender, and usually they're going to do this, I mean, really that's part of the lender's job, is to make sure that you're fitting into the best interest rate that you can get. But you're going to want to make sure that they've looked at different products for your credit score to make sure that you're getting the lowest interest rate possible. The third thing a lender looks at is the loan term. So is it going to be a 15-year mortgage, a 20-year mortgage, or a 30-year mortgage? 30-year mortgages usually have the highest interest rate out of those three. And then 20 can be about the same price as a 30 or a little lower. And then 15 years is always the lowest interest rate, or usually the lowest interest rate, but also obviously the highest payment because you're financing it over a longer or a shorter period of time. So depending on your goals, it might be worth looking at a 15-year because a 15-year payment isn't twice as much as a 30-year payment, but the interest rate could be substantially lower and it could save you thousands over the life of the loan depending on how long you're planning on being in the home. The fourth thing a lender looks at is called loan to value, or LTV. It's basically just how much the home is worth compared to how much you're borrowing. So if you put 10 or 20% down, you may fall into a different bracket and that may lower your interest rate. The fifth thing is occupancy. Are you buying the home as a primary residence, meaning a home that you're going to live in, or are you buying the home as a second home or an investment property? If you're buying it as a primary residence, you're going to have a much lower interest rate than if you're buying the home as a second home, meaning a vacation rental or like a beach house or something like that, or an investment property, because those are much riskier loans, so they carry a higher interest rate. And the final thing a lender looks at is it going to be a fixed rate mortgage or an adjustable rate mortgage? Fixed rate just meaning that once you close on the mortgage, it's fixed for the life of the loan, so 15, 20, 30 years. If it's an adjustable rate, and I'll get into this a little bit more into my tips because this is one of my tips on what to look for, but an adjustable rate, they usually carry a slightly lesser interest rate, but they're going to adjust over a certain period of time. So keep in mind, these aren't things that you have to memorize. They're just things that if you understand them or you know what they are, you can look out for them and talk to your lender about your situation and see if there's things that you can do to bump yourself into a lower interest rate. So the first tip is to shop multiple lenders. Most people don't realize that lenders will price match. Meaning that if you've talked to one lender and you tell another lender that you are quoted X amount, they can price match that. Now that can save you between like 1/8 to 1/4% or more, just depending on what the rates are for the day. But especially in this market, more and more lenders are willing to price match and give their best pricing up front because it's harder and harder to get loans right now. So tip 2 is to ask your lender when they're quoting you the rate if you're paying any points. Many lenders out there will quote you a rate with 1 point, meaning that's 1%. 1 point equals 1% of the loan amount. A half point equals a 0.5% of the loan amount. And that's a fee that you pay to have that interest rate. So you want to make sure that when a lender's quoting you that, you understand that that's built into a fee that you're paying. Now, it can go in both directions. They could quote you a rate with negative points, meaning they're giving you a credit for having that interest rate, but that interest rate's usually going to be higher. So on the reverse side, you could pay them points, and again, something that you can talk to them about to see how much that would be, but you can pay them extra money to get a lower interest rate. So if they quote you, say 5%, you could ask, well, how much would it be to get 4.5? Or how much would it be to get 4? And that's going to be a sliding scale. It doesn't go all the way down to 1. It's usually within 1% or 1.5% on their rate sheet. But you could ask them, can I pay extra? How much extra would it be for me to pay to get down like 0.5% or, 0.25%? This isn't always the best option, but it might be an option for you depending on how long you're planning to stay in the home. Doing this, keep in mind, is the longer that you're planning to stay in the home, the more worth it would be to pay extra to get a slightly lower interest rate. And you can combine the price match with the paying extra. So you could do a price match and then you could ask them how much would it be to price down from there, or to pay extra from there. The third tip is to lock your interest rate, or make sure that your lender locks the interest rate as soon as you're comfortable, or as soon as you agree on a rate that you're comfortable with. Interest rates change literally every day and sometimes multiple times a day, especially in this market. So it's really important that if you have an interest rate that you like, make them lock it in or have them lock it in. Usually locks are good for 30, 45, and 60 days, but you can have them lock it in until the closing, and that way your interest rate won't change on you. And the final tip is to look at an adjustable rate mortgage. Before you click off, hear me out on this, because a lot of people have misconceptions about what these are. And for your situation, and for a lot of people's situation, especially in a market where we don't know where the rates are going to go or what they're going to do over a long period of time, these might be a good option for you. So let's jump into that. So we haven't really had to use adjustable rate mortgages for a while because the interest rates on a fixed rate loan have been so low. But now that the fixed rate loans are higher, adjustable rate mortgages still carry a much lower interest rate. And a lot of people don't understand what an adjustable rate mortgage is. They think that it adjusts every 30 days or every 60 days or whatever. They think that it adjusts a lot sooner than it does. So let me briefly explain that, because again, you could save yourself 1% or more on getting an adjustable rate mortgage, and you could shop the other lenders to have them price match to lower it even more. So an adjustable rate mortgage is a 30-year mortgage, meaning the payment is based on a 30-year mortgage, but it's going to have a fixed rate for a certain period of time. So if you see a 15-year adjustable rate, or ARM mortgage, on a mortgage website, what it's going to be is your payment's going to be a 30-year payment, and then the rate will be fixed for 15 years, and then it will adjust every 6 months after that. Now, where this might be advantageous to you or beneficial for your situation is that a 15-year ARM, or a 15-year adjustable rate mortgage, carries a lower interest rate than a standard 30-year fixed rate, but you have the same payment as a 30-year fixed rate, or a similar payment to a 30-year fixed rate. So you could either pay it off in 15 years, or you could decide to refinance off to another fixed rate mortgage, depending on what the interest rates are. Now, the thing to keep in mind here, and the thing to be realistic with yourself about, is how long are you actually planning on staying in that home and keeping that mortgage? The average mortgage is about 7 to 10 years, meaning people either refinance or they sell their home within 7 to 10 years. So an adjustable rate mortgage with a 15-year fixed rate means that you would have those 15 years. You're probably going to end up refinancing, depending on your situation, or you're probably going to end up selling the home. So in that case, it wouldn't have mattered that you got an adjustable rate mortgage, because the rate would have never adjusted. It would have been fixed for 15 years. If you were creeping up on that 15-year mark, then you could see what the rates were going to do. Now, we have no idea what they're going to do in 15 years. So that's the risk, right? Is if you go to the 15-year mark and the rates are higher than what they are now, then you could be looking at a situation where your interest rate would go up if you refinanced. It's just something to be aware of, but you could have potentially saved a full percent or whatever it would be on your mortgage over that 15-year period of time. Now, keep in mind what I said earlier in the video, that a 1% change is $83 a month per 100,000 that you borrow. So you could potentially be saving yourself several $100s a month or more throughout that 15-year just by getting an adjustable rate mortgage that doesn't actually have any impact on you. And so the final tip is to ask your lender if you're close to the next credit score tier. Remember, as I said earlier in the video, your lender determines your interest rate based on your credit score, and it's a tiered system. So ask them if you're close to the next tier, and that could save you 1/8 or 1/4% on your interest rate. And it might be worth waiting a little bit. Instead of buying a house right now, it might be worth waiting a couple months to try to get your credit score up so that you fit into a better tier. And guys, if you want to find out more about how to bump your credit score into the next credit tier, check out this next video on how to increase and fix your credit score.